Well, let's go ahead and get started. We have a lot of slides on simplifying the balance sheet classification of debt, and we also actually talked to this group about this last year. So Jeff is going to take us through this, and we're going to get to the questions that we really need the answer.
Yeah, we're going to mainly talk about refinances, which is really where we've had a lot of the discussion in recent months. Let me just make sure I put this nice to my mouth. So this is our poster child of how a simplification initiative project can be anything but simple to complete. We've been going at this for about 3 years. As Candy said, we discussed this last year. What we're trying to move away from with this proposal was all this narrow rules-based guidance that's been put into place for things like springing lockboxes and callable debt and debt due on demand and subjective acceleration clauses and all sorts of other things over the years. Some of it is based on management judgments. Other things are based on what's actually in place as of year end. Some of the things you take into account events that have happened after the reporting period but before issuance. Others you don't. So it is a very complex set of rules. We proposed to leverage off of international financial reporting standards and come up with a basic principle that is focused exclusively on what is in place at year end, and that's on the next slide. And that is the liability actually contractually due to be settled more than 1 year out after the balance sheet date, or does the reporting entity have a contractual right to defer that settlement of the liability for at least 1 year after the balance sheet date? And we've had lots of discussions about a few different areas. Three that I'll briefly talk about, and two I'll briefly talk about, one we'll spend a bit of time on, are waivers of debt covenant violations, subjective acceleration clauses, and refinancings after the balance sheet date. So let's move on. We'll skip this polling question, right?
Yeah.
If we can. Okay. So debt covenant violations, this is one where the PCC was very, very helpful in steering the board in the right direction, or at least the direction that people tend to agree with, which is again, the question is what's in place as of year end. The problem here is that you're not going to know that you have a default situation. You're not going to possibly be able to obtain a waiver until the banker or whoever gets a set of financial statements, which couldn't possibly happen before year end. So you're basically in a catch-22 situation. So for both practical purposes and because some people could consider this to be a type 1 subsequent event, the resolution of an uncertainty as to whether or not the debt will be called based on covenants that existed as of or violations that existed as of the year end. For both of those reasons, the board proposed a one exception in this area. This is basically the same guidance that is in place in current GAAP with a couple of tweaks. The tweaks are that if the waiver results in an extinguishment or a troubled debt restructuring, the board viewed that as being akin to a new debt issuance, and that would not be within this exception. And then because there's been mixed practice out there about not just assessing the probability of whether the covenant itself would be violated, but whether other covenants in the debt agreement would be violated, it did put in the clause that it is probable that any other covenants will not be violated within 12 months after the balance sheet date. So with those two tweaks, basically we left in place the existing guidance. Moving on to subjective acceleration clauses. These are things that you will find in many debt agreements, but what we've heard is that they rarely are actually enforced, are actually triggered. Right now there is a probability assessment that is required about whether or not there's about the likelihood of actually these SACs being exercised. Going forward, we're simplifying it so that this is purely trigger-based. You would only classify the debt as current as opposed to non-current if the triggers occurred, which generally would be notification by the lender that they are triggering the acceleration clause. And then that leads us to the area where we'll spend a lot of time talking on, which is refinances. And this is an area where there would be a difference from current GAAP. Current GAAP takes into account management's intent in subsequent events, ones that you would pretty much any place else call a type 2 subsequent event that would not be reflected on the balance sheet as of year end. The board proposed that indeed this be treated similar to all other type 2 subsequent events, that again we're just looking at what's in place as of year end. This is not the same kind of catch-22 situation where you couldn't possibly get a waiver for a default. This is a matter of can you negotiate it before year end or not, and what cycle you're on. So with that,
So let's see if there's any panel members that have anything.
Want to say anything else here? Trying to, as I move quickly.
So anybody on the panel have a comment on the refinancing?
Yeah. Oh, on the refinancing? Not at this point, no.
No, not at this point in time.
This has been a topic of, I think, just about every PCC meeting for the last like 2 or 3 years.
It has, because this will be a big change for a lot of companies and a lot of our clients who are used to getting the classification if the refinancing happened before the financial statements were issued. So this would be a big change.
I just say that there are some differences of opinion at the board level, and we really would like input to the extent we can get it from this group.
So, want to move to the polling question and
Yeah,
let's start
I think
the
so.
dialogue?
What's the rationale for that?
That it's a type 2 subsequent event, that it doesn't provide, I think the classic definition is provides evidence, type 1, it provides evidence of something that exists at the balance sheet date. A refinancing doesn't. I mean, you can refinance with your current bank, some other bank, you could refinance using debt, you could refinance using equity. I mean, I think in the proposal, I think all 7 of us thought it was very clear it's type 1 subsequent event. Now, the question is whether we should provide some, exception to type 1 subsequent event and allow this type 1 subsequent event to be treated differently. We did that for waivers. One, I think Jeff said arguably you could at least say the waiver is more questionable because it is the year-end financials, but that is sort of linked to whether you meet the condition or not. I also think there was more sympathy for you can plan around refinancing a lot better than you can about whether you're going to be in default, and so some greater sympathy for that. And I think when we thought about, well, if you're going to classify your balance sheet based upon things that happen after year end, where should that stop? I mean, if you're going to use cash to buy PP&E, is that and you do it after the balance sheet date but before the financials are issued, should you say, well, also if you're going to look at my cash as being a current asset, by the time you get my financials, I've used it in some other spot? And so if the balance sheet is supposed to reflect the position at year end, this seems to do that, and I think that was the rationale.
Right. Okay, so the polling question. Considering everything that Jeff just went through and that Jim just further explained, do you agree with proposed guidance to not consider a subsequent refinancing after the balance sheet date when determining the classification of debt? Yes, no, or uncertain?
This is very similar to last year. I think this audience is fairly split.
Yeah. So, looks like around 54% no and about 40 to 42% yes. So, the majority, or over 50%, do not agree with the classification. So we would really like to get some feedback as to why you don't consider that. Oh, way over there on the mic. You're going to get your steps.
Yeah.
Over here.
We represent industries in which we have a lot of reporting to customers and other people in which likely a lot of times our banking and our financing sources do not close until the first quarter. Those items typically then could substantially negatively impact us for contracts and with our third-party reporting for payables and for people that we have to do in automotive contracts. The fact of the matter is that those items that get done, we have this for subsequent events and other items. I really don't understand why we would change it.
Okay. Yes. Someone over here?
My question is with regards to the differential between the subsequent refinancing and the waivers. And specifically, oftentimes what I see happen is that there will be a technical default that occurs on a piece of debt. and the bank may waive that, and as part of the waiver, they'll refinance the terms over some different period of time. So there's a clear intent that they be linked together. I don't know how you can take different positions when there's a true linkage between those two transactions.
So speaking for myself, I've sort of tried to make the same point, which is that I don't really think that the analogy to a Type 2 subsequent event is a perfect analogy, because the classification of debt is not the same thing as accounting for the refinancing. And so really what you're doing is just making under current GAAP, what you're really doing is making a pro forma adjustment in the classification of the debt. You're not changing the amount of the debt. So, you know, I would sort of be advocating more for current GAAP in this area. But I think the board has, you know, has at least tentatively a view that being more purists about what is actually the case on the balance sheet date and reflecting that is more in line with the direction of a principle-based standard. I think one of the things that is a little bit challenging here is the lack of user feedback that would be persuasive to articulate the same feelings that I have about it. That I would think that the users would want to know, as of the date that they're looking at the financial statements, whether the company has a current debt, you know, a current maturity issue, or they don't. I think you could clearly disclose a refinancing in your footnotes, but it's not really the same as reflecting it in the classification of your balance sheet. So, you know, reasonable people can come to different conclusions about it.
With regard to the Type 1, Type 2, and the bad debt reserve, we consider a subsequent bankruptcy to being a matter which existed at the end of the year when we measure, Type 1, Type 2 measure the bad debt reserve. It's a similar situation, it seems to me, with regard to the renewal of the debt. That is, the situation existed as of the end of the year, which allowed us to refinance the debt after the end of the year. And the fact that contractually we were not called on at the end of the year to do so doesn't change, I don't think, the Type 1, Type 2 criteria. It would still be a measurable event, because the event, the matters existed at the end of the year that allowed us to do something later.
Do you feel differently if the refinance was with a third party?
I'm sorry, say again?
Do you feel differently if the refinancing is with a different party, a third party, a different party than you?
Uncertain.
It would be a new financing, in other words.
That's kind of the way that I look at it, is that, to me, while I somewhat like the current accounting, I mean, looking at it from a Type 1, Type 2, I see the refinancing more often to be more closely associated with a new executed agreement. It's much more of a stringent underwriting process, typically, than what you are going to have in the case of a debt waiver with an existing relationship. I think, too, that if we were to continue with the refinancing, there's some problems in the refinancing literature itself. It isn't always just same amounts rolled over. Sometimes they are for different amounts. They could be 10 months after the end of the year and an entity is paid down. A good bit of one debt gets more during the refinancing process, and that complicates what's a current liability and what is a long-term obligation. And at least in practice, I've also seen that many times that companies use it as an option to base the financial reporting on the new arrangement, when in fact it's not an option. You have to go back and apply it as of the balance sheet date. So,
to Tim's point, I mean, this isn't necessarily an easy call for the board, and this wasn't a project that the board said, let's go take this up. This actually came from constituents. I think this happened to come from auditors, happened to be principally auditors of public companies saying, simplify this area. I think it was early years of the PCOB, this is one of the highest areas of restatement because even the largest of firms were getting it wrong because of springing lock boxes and some of the other issues. I think the issues that Jeff was just talking about are high areas for restatement. I think the board will have to redeliberate and say, well, should we just do nothing here and leave this sort of mismatch of the issues that Jeff talked about in the tee-up of some of it's based on intent, some of it's based on, balance sheet date, some of it's based on probability assessments, or could we come up with a simpler model that just says, look at year end, and what exceptions, if any, should we have to that?
Danielle?
So I have only very micro-sized clients for what a lot of people do in this room. And the problem they have is that they plan to refinance before the end of the year, and it's mainly just a terms extension is what really ends up happening as their refinance. But the bank, very similar to the covenants, wants to see their final financial statements. They're such a small client, they don't rank very highly in the book of business of the bank. And so sometimes the debt actually expires before the bank will actually renew them, just from a practical standpoint. And so this is actually going to be very detrimental to them because they'll end up with a lot of current debt that would, if they were a bigger company, they'd probably get more attention from their bank. And then those financial statements do go, especially on construction contractors, to bonding companies, state licensing boards, and can impact their bid process. So this could actually have very serious economic consequences that are unintended for my clients.
Anyone else?
I totally agree with you. I have some clients that are real estate clients, and sometimes when they have the loan payments, if it's 15 years and then a balloon payment at the end, and when it's the timing when they're not getting, the refinancing is happening subsequent to the year, and I am in favorable of the current gap right now because it's tell the reader that the report date and the subsequent events is reflecting on the balance sheet that they are able to refinancing it. It doesn't show that they suddenly have a big current liabilities when in fact they were able to renegotiate all of that, and that's detrimental when they go to their investors with their report.
And we've heard this issue, and it is another one of those. It's a really challenging one for the board. Another way to sort of think about that is the bank isn't willing to refinance until they get to see the picture at year end, including, so they want to see the year end results, knowing full well they have either the option to extend or not. And once they've made that decision, say, well, report the decision that the bank made after year end to the other investors as if it existed, or, the other users of financial statements. I think in that case it was investors. In this case it's bonding companies or others. Saying wait and report the decision the bank made after year end, but reported in the financials. And it's a tough call to think about. Are you really just giving them privilege to banks as users over other users?
But on the other hand, using that same idea, they're waiting for that year end information, but that's year end information that existed at the balance sheet date. And they are working through a decision, but that decision is really just confirming the fact that this was not a short-term liquidity need based on the fact pattern that existed then. So, it's a question of, it is a tough call.
I voted yes for the reasons that you articulated, the type 1 versus type 2. What I'm hearing from the audience is more, as FASB prioritizes, is this really a high priority because of the fact that current users are okay with the way it's been, but I suppose the other alternative would be to do the pro forma. Well, this is what happened after year end. One question that occurs to me, and I don't know if you've talked about it, if this proposal does go forth, I could see a real challenge with respect to implementing the going concern disclosures on a company that is otherwise healthy but has a a loan ballooning, and specifically because of the fact that the going concern pronouncement has some disclosure requirements, even if substantial doubt is alleviated, would there be an interrelationship between the fact that if this proposal passes, we now have a big negative working capital? What does that affect the decision as to whether the sort of first phase disclosures would be required, even if substantial doubt is alleviated soon after year end because of a refinancing?
I may not be completely thinking through the issue, but I think that whether the debt is classified as current or long-term, that what you need to do from a going concern perspective is to evaluate whether or not the company is going to be able to repay it in 12 months from the date of the issuance of the financial statements. So whether it's classified as current or long-term, to me, doesn't seem that it directly impacts that decision.
What I'm referring to is under the going concern standard, if there is substantial doubt but it's alleviated after year end, there are still some disclosure requirements that substantial doubt exists and it was subsequently alleviated. My understanding is the only time disclosures are not required is if management already has plans in process by year end that would take care of it. So it just strikes me as an area of potential practice confusion that if you go forward with this, some guidance on that point might be helpful.
Go ahead, sir.
I think I would encourage you to read the going concern requirements really carefully, because if management has a plan and substantial doubt is alleviated, yes, there are disclosures, but it's about refinancing your debt, or it's about whatever management's plan is. It doesn't necessarily say that you have substantial doubt. You don't actually have to use those words.
I understand that, but under current GAAP, I'm sorry I'll stop after this, but under current GAAP, the issue would just never come up because it's been refinanced after year end. Working capital is positive. Management would not even, but if this goes forward and there's big negative working capital, it seems like that might at least start management down the road. And so
I think it's a good point, and one we ought to at least make sure we've thought through if we finalize it, and if we think there is a significant interaction, probably have a discussion about that. If there isn't, maybe we could have a quick discussion about it, but if there is a substantial interaction, it's something we ought to highlight.
And maybe there's an interest in making sure that the PCAOB reads the standard, the going concern standard as well as Sue does.
That might be a separate issue.
I've just gotten that question repeatedly.
I voted no for many of the same reasons that have already been discussed, but to address Mr. Kroeker's question as to are you putting one user over the interests of other users, you have to realize that for many small privately held companies, the user is the bank. There is no other user other than the owner and possibly family members. This isn't a big entity world that many of our clients live in.
No, and I understand that, but if the user is the bank, then this shouldn't be problematic at all because the bank already knows the situation, whether it's current or long-term.
Except that, they want to see what the financial statements are going to look like after the refinancing. That's what they're asking from us. That's what the banks are asking. Also, what the gentleman just asked about going concern, that's going to trigger negative working capital, and now I got a going concern issue.
I guess sort of to Tim's point, and I don't need to belabor this, that to be useful maybe to get that input from banks because and it's hard to figure out what's happening in the real world, but banks have told us it's not what they're doing. And you probably know better than, but they're certainly not saying that they're not reaching out saying don't do this. I think they've told us they understand it.
Most of the bankers I work with actually request that we present it as if they were to refinance, because otherwise it doesn't fit in their models very well, and they just key in their numbers, and a lot of their underwriting departments, particularly for these micro size in comparison to a lot of other people in the room, they're just plugging in numbers and they're seeing what their ratios hit, and if their ratios go wonky, it creates a problem.
Yeah, for my clients, I just went into a practical experience that most of them, they work very closely with the bank. So what they want is they're asking for a draft financial statements, and they say that, the auditor making sure that they're on good with everything else, except for the debt portions, that they understand that part. So the bank get to see the draft before and get into the issuance. So when it's the issuance, then they'll see the new number. I agree with her point. So it's really the client, the bank relationship is very close.
We're just saying, I don't know if you want to go to question 9, which is the question about the same lender, if that, curious to hear what the audience says about that.
Okay. So question 9, in order to result in non-current classification, should short-term debt be refinanced with long-term debt by the same lender? Yes, no, or uncertain.
So if the board was going to grant an exception or whatever, should it be dependent on it being the same lender, for example?
So, looks like we are over 50% no and 35% yes and 10% uncertain.
Okay.
So it would be very interesting to hear why with a different lender makes a difference. Who would like to tell us why they voted
So someone that voted yes, right?
Right, correct.
Anyone want to volunteer? Those who said it had to be the same lender? Okay. Thank you.
I just had a situation with a client where they had a balloon payment that's coming due in 2017, and they were trying to refinance with another bank because we said, well, if you want to have it as current, it has to be refinanced. The first bank fell through, the next bank they're working on, they need the financial statements. So they actually got a related party to pay off the balloon payment with a maturity that's now in 2018. It's still within a year of when we're issuing the report, but it's not within a year of year end. And it was a total, it's current debt. But because of the way the rules are now, we were able to say, okay, well, you got it refinanced. Even now you're going to refinance it again. So that's why I said if it's with the same lender, I understand. But this nonsense they just went through, it's clearly current debt.
So if it was, you would agree that it should not be current debt if it was with a different lender? Yes.
Wait a minute, it should be current debt if it's with a different lender, right?
Different lender, yes.
Yep.
Did I say it backwards? Maybe. It's late in the day.
Anyone else want to weigh in on that?
Yeah.
Oh, all the way in the corner here.
We have Jeremy
Give
over
me a
here,
lot of
too.
steps now?
Yeah, I said yes also because to me, I understand the type 1, type 2 logic that you laid out, and it makes a lot of sense. I look at it if it's with a current lender, it's an existing contractual relationship that's being modified or extended versus an entirely new contractual relationship or contractual arrangement.
And I certainly appreciate that point. It's easier to argue what you're trying to figure out. It's rolling the debt. I think the point that was made earlier doesn't mean we shouldn't do this. One of the things at least we've got to think about, does it create a competitive advantage? So, you want your current debt, you got to stay with the current lender. Current lender may understand that. Current lender may impact that into pricing. Do you have as much competitiveness? But that doesn't mean it's not an issue we shouldn't think about.
And I guess I'd add that in a lot of lending situations, you're dealing with a syndicate of lenders. Maybe there are 10 in your syndicate, and there's one lead lender, and and you may refinance with one of the other 9 banks, or one becomes lead and the other becomes secondary. And really, should that be the be-all and end-all of whether or not, of how you classify your balance sheet? But I have reflected on, a lot of the discussion here, and remembering that this was an agenda item that was put on the board's agenda for simplification. And this is sort of an area where no good deed goes unpunished.
I actually think that's the biggest question we have to weigh. Is This was not on our agenda just because we said, look, well, let's take this area on.
I think, I voted no. I think in the spirit of thinking about principle-based standards, we should look to the ASC 210 definition of current liabilities. I don't think we should be treating one type of subsequent event one way, like a waiver, allowing it to be classified as non-current, received subsequent to year-end, but not treating a subjective acceleration clause in a similar manner that was received after year-end but prior to issuance of the financials. So I think it's very important to look back at the definition and in ASC 210 and really focus on that and have a principle-based standard that will be very workable and I think come to logical conclusions rather than these bright lines and exceptions to the normal subsequent event criteria. And that would address the refinancings subsequent to year-end with the same bank, different bank, as well as the waivers, subjective acceleration. It would really provide a simple framework to address all these issues under.
Okay, thank you. Anyone else? All right. I think we have one more polling question on this. I think it'll be interesting to get the answer to this. Mike. Okay, so do you believe that short-term debt at the balance sheet date that is refinanced with the issuance of equity after the balance sheet date, but before the financial statements are issued, should be classified as non-current liability? So, a larger majority believe the answer is no, 67% no, about 22% yes, and 10% uncertain. So it would be interesting just to hear a few comments on the rationale from the no's.
Anyone want to volunteer that?
Want to volunteer?
Sorry. Okay, right over here.
It's at the end of the balance sheet date. I mean, you can't go one way with one and then go the opposite direction and the other. Then you're really going to confuse our clients.
I actually agree with you.
No matter if they're private or public.
Anyone else have a different? Yes.
No, I agree with him. I think that in this scenario, you're changing the character of the transaction. It's totally different.
So I think that's a consistent theme with what we have said, I believe, or a lot of us have said. Okay. So any other comments on balance sheet classification of debt? If not, we will move.
Candy, I was going to ask, so what's the next step since we couldn't get a unified answer here? So is there a next step or are we keeping this status quo?
So the next steps are that the staff will be bringing back to the board in July comment letter summary, the comments we received during the comment period and feedback that we've gotten outside of the comment period and also some additional outreach that we've done. And then we'll decide our plan for redeliberations.
I suspect staff will capture some of this input. I mean, we've got the PCC input as well, but we'll capture the input today. Much of the input today, I think, is covered in comment letters, but I think some of the polling questions could be useful as well. It's hard to do polling without the dialogue, which is why I think probably all of us appreciate hearing what's behind the polling numbers.
And if any of you can, talk with users, if we can get a higher level of response from the users, especially in the private company arena, that would be very helpful.
Right. So we are scheduled to end at 5:45, which is about 15 minutes. And we have many more topics that we were going to present to you today, but I think we have spent our time really wisely talking about some of the more significant issues. So I would like to actually throw it open to the group. We have lots of questions that have come in through the apps, and there's one in particular that I want to just touch on, and it's the one that's gotten, I think, the most responses, 38 responses about, I'll just read it to you. It says, when the Blue Ribbon Panel was originally created, the feedback showed that people wanted to move from one gap to big gap and little gap. FASB and the FAF rejected their findings and created the PCC. With some of the latest GAAP changes, revenue recognition and leases specifically, it is clear that the PCC is not looking out for small companies. For example, the cost to implement leases and revenue recognition is ridiculous for small entities, especially when most of the GL software has been updated to deal with RevRec. Where was the PCC when we needed you? So, okay. So several of those projects were well down the road before the PCC was formed, and I'm not exactly sure that that's a correct characterization of what the Blue Ribbon panel actually came up with. Who?
Jeff.
No, I was the lead staff person for it. So no, that's not. They didn't not want a big gap and little gap. They wanted one gap with exceptions and modifications for private companies, which is why they originally recommended a separate board, but not a separate board to create a whole new gap. It was a separate board to work with the FASB to make exceptions and so on. The final vehicle ended up being the PCC, but it's very much along the same model.
And so I think we also need to go back to the beginning when I was mentioning what our framework is. And our private company decision-making framework, it specifically spells out, and that's what the PCC and the board and the FAF all agreed to whenever, and it was exposed whenever the PCC was created, is that we are required to consider cost and complexity, but focus on user relevance as the higher priority. So cost and complexity is a consideration, but user relevance is the higher priority. And whether or not the PCC will take on a revenue recognition project on our agenda or a lease project on our agenda, I think we did not see in the comment letters a lot of groundswell from the users that this would not be relevant information. And the revenue recognition standard is getting rid of all of the industry-specific guidance and putting it all into one broad revenue recognition principle. So theoretically, after we get through the transition, it should be easier because you're not going to have to learn all kinds of industry-specific guidance. But that doesn't mean that if there is a reason from a private company perspective that warrants the PCC to look at it, we would consider it and take it up. So, Jeff?
Yeah, I think, too, going back to the private company decision-making framework, that, yes, there's going to be times when there's going to be changes in the recognition and measurement principles, but those are going to be very few. Primarily, it's going to be in the disclosure area. It's going to take into consideration access that maybe the users have to the private companies, but it's hard to really justify why revenue is a different thing for a private company than it is a public company. It's probably easy for me to sit up here and rationalize because it's highly likely that I'll ever be involved in the adoption of the standard. But I think, too, that we've all gone through things in our career that are pretty difficult to go through. First-time adoptions, they're painful, whether it is some of the income tax, the FIN 48, total overkill in year one, but in year two it got better, and in year 3 and 4 it's just part of what we do and not a big thing. Those of you that were in the working with public companies, internal control over financial reporting, we've adapted to that. But I think the one thing that's going to come out is that as we go through this process, we're probably going to find that maybe the revenue recognition policies of our clients weren't so good. Maybe they weren't exactly GAAP. And so we're going to, through a change in accounting principle, if you will, clear up some sins of the past. So that's may not make you feel any better, but it's hard for me to see that revenue recognition really should be much different for private companies than it should for public companies.
This is an area that I struggle with is how do you think about the cost of change? I mean, we hear a lot of the same comments on revenue recognition from public companies. The cost of change is even bigger on small companies when you take it across the revenue, just as it's regressive the smaller you are. So how do you think about the cost of change? I mean, I can think of areas that I wouldn't have voted for individually in revenue recognition. I think that weren't broke, and I don't mean to do that to complain. You know, you got 7 board members. Sometimes the sausage making gets ugly. But I do hope that 10 years from now, we actually have an easier revenue recognition world than we do today. I mean, frankly, you know, I got out of school and I didn't know anything about software revenue recognition or, you know, why we have different revenue recognition or different cost guidance within revenue for cable companies than you do for telephone companies. And that stuff was written before, you know, they started to even merge together. We had software guidance that we didn't even know how to deal with something like this phone. Is this software? Is it hardware? Now we have one base model. And I don't mean to minimize the cost of change and, you know, that the issues that private companies face are different from public. But I hope we take a step back and in all sincerity in a PIR after revenue and said, you know, was this something that was right? Did we factor the cost of change in? Should our standards be more evolutionary as opposed to revolutionary? And I know that doesn't help you today with RevRec, but it's sort of some thoughts that are incremental maybe to Jeff's.
So PIR, Jim, you touched on that. Sue, what is the criteria for a PIR?
Well, on the revenue recognition standard specifically, we have what we call post-issuance procedures and sort of post-effective date procedures. And so to sort of post-issuance, we've been monitoring implementation. You know, Harold talked about the transition resource group this morning. We have technical inquiry lines. We have other mechanisms for which we monitor the questions that are coming in to understand whether there's a lack of clarity somewhere within the standard. And in some circumstances, we have acted in terms of issuing updated ASUs clarifying aspects of the standard. Post-effective date, we are planning to do some review of costs. We have been talking to companies along the way about what their potential costs were for implementing the standard. And we plan to sort of revisit that with them to understand whether it was, you know, much different than what they expected. And we'll continue to monitor, again, implementation so that we understand whether there's diversity and those types of things. So a lot of the types of activities you would anticipate in a formal post-implementation review, but we're sort of doing them along the way.
Just real quickly, as a quick counterpoint to the 38 people that voted on that one, I was on FASAC at one point in time, and I've seen the standard setting process for probably since 2000 on, and watching the changes with the private company financial reporting, watching the PCC, and going to the meetings, I can tell you, even in this room, people don't come to conclusions on issues that come up, and I think that change in what's happened is nothing short of extraordinary. The tone at the FASB, the receptiveness to private companies is unbelievable. The job I think the PCC has done and the FASB have done and the staff have done is just extraordinary. So I definitely want to applaud you on sitting here and talking about VIEs and the changes that are proposed on that. That's pretty extraordinary, and that's things that I think that we've been talking about for a while, and we're actually seeing some action on it. So I just want to say thanks.
Thank you for that. One thing I wanted to mention is that as we go through and develop these standards, you know, we're constantly thinking about the private company decision-making framework, how that overlays, whether there should be differences or not. Particularly, Jim pointed out on revenue that it was just as relevant. I think Jeff pointed out as well that it was relevant to public companies and private companies similarly in terms of their users. One thing I wanted to point out is that there are some accommodations and some expedients, if you will. On revenue, not so much on recognition and measurement, but on disclosures. There is some disclosure relief there. On leases, for example, there are some expedients on the leasing guidance as well. For example, Harold talked about this morning the use of the discount rate. I know that there was some question about how do you account for leases that may not be documented, even though it may go on from year to year, but that you've only got, or you don't have an arrangement, or you have a very, monthly arrangement. In that instance, we talked about accounting for it in terms of the arrangement that you have. So if you have an arrangement and it's only a year, that's what you account for. And so I think, in addition, on leasing, there's accommodations for private companies as it relates to disclosure relief as well. And so I don't want to lose sight of some of those things based on the good feedback that we got from the Private Company Council, private companies and those users as well that provided input from us. So I thought I'd just mention that.
My recollection is that related party guidance on leases that Sue talked about was recommended by, PCC had broader recommendations, but I think they did say, as it relates to related parties, which is, more prevalent in private companies, don't make us infer some agreement that doesn't exist, account for the agreement that does, and if one doesn't, then there's no lease to account for.
Right.
And maybe, Candy, if you don't mind me just adding,
Sure.
I agree in large part with not necessarily the specifics of the question that was asked, but I understand that the frustration, particularly as it relates to the pace of change. And that was one of the things that came out of the blue ribbon panel, was the pace of change can be particularly challenging for the private company universe. And I think my sense is that FASB has been, when they've put new things on their agenda, I think they recognize that they've not just put a pig in the python with revenue recognition, but two pigs with revenue recognition and lease accounting. And I think as you've seen them put new things on their agenda, they're largely focused on simplification, largely focused on more targeted things now, knowing that the two pigs have to get through the python before they can start to tackle bigger things again. And I think a lot of the new things that are coming out are for the most part elective, things that you can opt into some relief. And so I think when you look at the way the FASB has acknowledged some of this feedback, I think it's helpful.
I guess also just hearing all the comments, of course I can blame all the old board members for what they've done, but I'm not going to do that. Just reflecting on the comment, I know a lot of the super large firms have put millions of dollars to develop AIs to ease up the implementation of revenue recognition or leases. I think it will be probably in the short, very near future that we'll see companies like Google's or AI or one of the big fours will really use AI to read all the contracts and then spell out accounting for all of us. So I would also want to make sure that the board take that into consideration with the speed of technology nowadays. All of us are not really driven the implementation of those new accounting standards. I think that it's the companies of the world, like the Googles, will be ultimately driving those accounting in the future. So I guess keep that in mind. How do we still make sort of the broader principles of the accounting relevant to all of us here in this room, because we couldn't really have that sort of investment into this technology or process into the future.
Question over here.
Sure. I don't want to beat the ASC 606 issue to death, but there is a practical limitation that is affecting private companies, which is that the vendor who make the cloud-based and desktop-based software that they use to run their businesses, QuickBooks, Sage, Xero, they don't have anything on their radar. There's nothing. There are no automated solutions, and frankly, the smaller companies, automation is more important than it is for the big companies, because it would impose the discipline on them to document the judgments that are necessary. It's literally not feasible for these companies to adopt 606 as written. If they do it on a spreadsheet, it's going to be a train wreck. So I
think that's helpful input. We did some outreach when we extended the standard more to public companies. Obviously, the effect. Well, this was because they were already in process of adoption. So I saw sort of the concern there. They were actually in the process, and we went out and met with them to see where they're at. I think we're now about in that phase a year later for private companies, where some outreach to see what is the state of technology, what, are their systems today integrated with, 605, and how did they get that done in terms of the software providers, and where are they as it relates to integration with 606?
Literally, the 606 solutions that exist now are really written around ERP software. And private companies often use general ledger packages and ERP is something that they would never even do. And it's just, I don't know how to advise them, honestly.
That's helpful, and that's something that, that we'll be talking about with the board in future meetings, so thank you. Okay, we have 1 minute left. Does anyone have something urgent or emerging that we really should know about before they head back to Norwalk and we all go where we're from?
One last thing I'll say. I've been part of TIC and seen how some of the sausage is made, to use your phrase. And what I walked away with, one of the things was there's a distinct difference between something being broken and being hard. And this right now, based on my learning curve, I'm somewhere in the middle as far as understanding 606. It's in the hard bucket. And it's just, for me, I like that it creates opportunities to provide client service, to go out there and even have implementation projects for other clients. But it's not broken as far as I can see. It's going to be hard for everyone. But to Tim's point, that's the first year blues of implementation. And then after that, we all adjust and the learning curve becomes a lot simpler.
Okay. I want to thank you all for your time and attention. We really appreciate your feedback. This is very important to us as a PCC and the board. So thank you very much. Enjoy Vegas.